Good day. It's not a good day for the markets necessarily, but it's a good day for us because we got a lot to talk about, including why the markets are selling down, which really is pretty obvious, in my opinion. Everyone's talking about it. It's all over the news, and it seems to be the headlines driving the market. And that started the other day. We're talking about increased evidence of spikes, increased evidence of higher infection rates, increased evidence of, again, I hate to say it, an increasing mortality rate in some areas. And to make matters even worse, there are all kinds of stories out now from all across the world. The latest I read was out of Israel on side effects of COVID-19, what doctors are discovering only now. Some of the things we had some idea about, some scientists and doctors had an inkling that there were signs of certain things that were byproducts of the virus. And now it seems to be that those feared things are coming to pass. And the statistics are bearing out that there's a lot more to this virus than originally thought, a lot more. None of it good. So we'll touch a little bit on that, but the markets right now, as I pick up with you, where Dow's down 560 points, about 2.13%. S&P down about 2%. Well, it's actually backed off a little bit now, down 1.68%. NASDAQ Composite down 1.42%. VIX up 7.2%, not unexpected. It's Friday after all, okay? So we came into the day on the heels of yesterday's late rally into the close. Markets kind of really wanted to close on the highs of the day yesterday after being sloppy all day, trading down. And then what do we get? We get a rush to buy at the end of the day. A good sign. Unfortunately, it couldn't be continued today. There was there should have been some momentum, but there wasn't any because the news simply hammered down investors' expectations. And the thing that hung over investors yesterday came to the forefront again today, this time with a little more stridency and certainly a little more impact. We can see that obviously in the markets selling down. European markets today were fairly robust, up substantially. The CAC current was up more than about 1.5%. Since then, all across Europe, indices have sold down, and for the most part, ended the day slightly lower to a bit lower at that. And that's after giving up some good gains. So that was a reflection of what was happening in the U.S. So the U.S. ended up being the tail wagging Europe as the dog. So here we are. Will we close lower today than we are? Will we bounce off of the lows? It's probably anybody's bet. My expectation is that we'll see some perhaps increased selling in around the 2 o'clock hour, and that may be the determining factor how investors react, position themselves starting around 2 o'clock, because that's when the pros come in and start to move some of the sides that they have going into the weekend. So we will see how retail adjust to this. Some of the stocks that we've talked about are certainly cheaper today, Wells Fargo being one of them. We will take a look at that. I like a Wells Fargo down here. And let's talk about the banks. Let's talk about another thing that's weighing on the market that started yesterday afternoon. This is the Federal Reserve. These are regulators leaning on the banks, if you will. Not going to permit them to increase their dividends or conduct buybacks. I don't think any of the banks really would have had the nerve to start to reinvigorate their buyback programs, and all of them had them, except there's no reason to be buying back stock now if you don't know what your earnings are going to look like. If you're coming into a recession, that just doesn't bode well. And with all the help and liquidity that the Fed has offered banks, for them to conduct buybacks would be a slap in the face. So that really wasn't going to happen, in my opinion. As far as cutting dividends, the Fed has given them till September to say they can't raise their dividends. The Fed has not imposed, no one has imposed restriction on the banks paying their dividends. They're not going to stop paying their dividends unless there is a good reason that they're having to stop paying. And by having to stop paying, I mean the earnings are so bad and or regulators demand that they cut back on their dividend payouts to preserve capital in a countercyclical kind of move. So just because it's happened in Europe, because that's what European regulators have now imposed on the banks. They want the banks to cut their dividends. And again, this is what's called a counter-cyclical move, even though it's not counter-cyclical now. But banks generally, the whole idea of a counter-cyclical move is when the banks are doing well, when the economy is doing well and banks' earnings are doing well, you put aside more capital for a rainy day. That's counter-cyclical. And then when you come down, you don't pay out the dividends, but you've got that capital there at the ready in order to settle down your balance sheet and investors' expectations for what you can do in terms of smoothing out your earnings and not having to take huge hits because you've already provisioned for them. So banks in Europe are in much, much worse shape than U.S. banks, and that's just a sign of what banks have gotten away with, and that's a sign of the European Union. That's the way the union is constructed. That's the worst thing about the union. That's why the Brits never signed on for the euro. Obviously, they accept the euro, but they kept the pound. They didn't want to be part of the currency union, and for good reason. And this is why the Brits are now exiting from the EU. There's just too many issues with the European Union backstopping and essentially allowing banks to cover their losses. That's a problem. It's a gigantic problem. So I'm getting some ringing here. Nope. I thought someone was going to call me and tell me that maybe you guys can't hear me. So hopefully everything is good because I'm getting a spinning wheel on my computer. But it appears to be I've got some questions coming across. So hopefully you guys are hearing me loud and clear. But the banks in Europe are in terrible shape. So it is certainly no surprise to me that regulators want them to cease paying dividends. Where that goes ultimately remains to be seen. The regulators here, perhaps just tearing a page out of what European regulators are doing, came out with some statements that this is what we want to see happen and this is what we're imposing. It doesn't mean, and I'll say this again and again, it doesn't mean that banks have to stop paying their dividends. So I'm specifically talking about any of the banks that you own, that I own, that we own, that anybody owns. I don't expect banks to stop paying their dividends, and that includes Wells Fargo. All right. The worst thing that could happen to Wells Fargo is for them to cease paying their dividend. The absolute worst thing that could happen. Second to that would be to cut the dividend. Okay, the stock has been hit. It's been a laggard for good reason for some time. Okay, now down where it is trading today and where it might be going to make its perhaps new lows. The last thing that the bank wants to do is signal to equity investors it's time to bail out when a lot of them have hung in this long because of the dividend. So to cut the dividend now when they don't actually have to cut the dividend would be something that would be only foolish. Management cannot afford to do that. The equity would get hammered. If the equity gets hammered in a bank, and we're talking about Wells Fargo, that reflects because their equity capital is part of their total capital. They are looked at in terms of their balance sheet, in terms of their assets, and in terms of their equity, as far as what kind of capital do they have. Though that capital, those ratios include equity in terms of capital reserves, in terms of what the bank has to maintain. If equity capital gets hit because the stock price gets decimated, that impacts the bank's reserve requirements, all kinds of regulatory issues. They cannot afford to have that happen. The Federal Reserve certainly doesn't want to have that happen, because if you have a big bank in the United States look like it's in trouble, guess what? We're all going to be shorting, because that's the first thing that's going to happen. Is I don't care if it takes a day, we're going to put as many short positions on folks as we can, because if that happens, then we're in trouble, big trouble. The financial markets are in trouble, the economy is in trouble, and we're going to be in trouble for a long time. So the last thing the Fed is going to allow is for a big bank, a too big to fail bank, see its equity decimated because it has to cut its dividend. Okay. They're not going to make them cut the dividends. They're going to allow them to maintain the dividends, and that's perfectly fine. Wells Fargo cutting its dividend would be the most ridiculous, stupidest move I would have ever seen a bank do. So cannot imagine it. Doesn't mean that they won't. Doesn't mean that it can't happen. It just means that if it does, we're going to have to reassess all of our positions. I'm going to have to reassess my opinion of the market, and that'll be probably an instant reversal in terms of my leaning towards the markets having a propensity to continue to have to make it higher. But today isn't the be all end all. We haven't finished the day. We're just coming into the midday, and so what? So far, it's okay. We haven't seen panic selling at all. We've just seen profit taking, and on the heels of lockdowns coming, we know they're probably going to come. Houston is making some moves. Florida, I believe Florida's governor DeSantis, I believe recently, just maybe minutes, half hour ago, sometime recently, came out and said that there's no liquor going to be served at the bars. That's not a shutdown. That's not a shut down the bars. That's not a lockdown, and that's not a stay home. That's simply, okay, there are too many knuckleheads at too many bars gathering and not social distancing. So let's stop. Let's start there. Let's put a stop to that. So no liquor at the bars. Okay, not closing the bars. I'm not that. Who's going to go to a bar if you can't have a drink? Nonetheless, this is indicative of what governors and mayors are going to do. They're going to try and measuredly close things down, tamp down what's happening so they can squash these spikes, which are frightening. So we're going to see some other things happen in some other states that won't surprise me whatsoever. So let's take a look at a couple of questions. We'll take a look at the markets, and I want to talk about dividends, and then I'm going to look at a bunch of stocks with you guys. So a couple of quick questions. Ruby, time to get out of indexes? Not yet, Ruby. Great question. We're going to take a look at all the majors, and we'll make a determination about whether or not they look like they are weakening to a point where we want to start considering getting out. They may be getting to a point we want to start thinking about what we might do, or maybe how to hedge, or maybe to put on some selective positions. So yes, we're going to take a look at that, Ruby. But right now, I don't see it as being a time to get out. We haven't crossed that Rubicon. The market, the trend is still up. Again, this is profit taking. It hasn't been ugly, and there's nothing here. There's no panic selling. So what we're seeing is pretty much expected, and we have the playbook. We know what equities do when things get shut down, when the economy gets shut down. We know that, but we also know that they quickly turn around and go, well, this isn't going to be forever. They now know it's not going to be forever, so we know what the playbook looks like. I can't imagine equities selling off really hard on this news. However, that being said, if these knuckleheads who are going out and spreading the virus don't cotton to some good sense, and this continues, we see it nationally, then all bets are off. So that's really a problem. The real problem is the potential for shutting down parts of the economy. That's what the market is most afraid of. And so far, so good. We're on the periphery of some things that are nerve-wracking, but we're not there yet. Again, we'll take a look, Ruby, at all the indices and see how they look and they measure up. Pat, what do you think of SO as a stock option play? Southern Company, again, we see oil coming down a little bit today. So the oil companies and the railroads and a lot of transport companies, pipelines, energy companies, I'm not really inclined, and the stock hasn't been doing that well. It's kind of fallen off a cliff. It's fallen through. It looked like it was consolidating, Pat. And I above probably say 52.50. It was holding in a sideways pattern. It's broken down now. With lows of today are 50.40. So 50 to me is like, you're really now at a point where it could go a little lower. So What do I think about it as an option play? It depends on what you think it's going to do, whether you're going to play for the downside or for an upside move. Right now, it's just not something I think it's going to move quite enough right now for me to want to play. If you have a long-term conviction on it one way or the other, then I say go for it. But me, Southern Company doesn't have enough volatility for me in this environment to want to move in one way or the other. And it's not for me a long-term hold right now. I like the dividend yield at 5.07%, but how sustainable is that in the market? It remains to be seen. So we'll take a look at Southern another time, but that's the short run on Southern. Shelly, hi, how are you? Did we talk about these REITs, BRG and IRT? We'll take a look at them graphically. We're going to talk a little bit about REITs when we pull these up. So thanks for bringing that up, because I want to talk about REITs in the context of dividends. We know that they have to pay out, the REITs have to pay out 90% of their taxable income. So we'll take a look at BRG and IRT. We pull up the chart, Shelly. Frank, hi Shah, hi Frank. Riding two stocks, CGNX and ESPO. Do I have a favorite? Let's take a look at them graphically. How about that, Frank? Maybe give you a little more color as we look at them graphically. So just trying to go through some of these because I want to get into a little bit about dividends since we're on the subject of that with Wells Fargo and its huge dividend yield, which is a lot bigger today. As a matter of fact, let's just have a quick look because I am curious. And dividend yield on Wells Fargo is nearing 8%. So again, I'll come back to that. It's also coming down to it's at some support right now. It doesn't mean it can't break through that. Stock's down 6.36%. It's being hit hardest of the banks today with good reason, because everyone looks at the big yield and think they're going to have to cut it. Again, they may, but I'm betting they won't. Hi, Frank. How are you? We'll talk more about that. Ruby, thanks for info in Total Wealth. I'm glad you like that. I'm revamping Total Wealth, Ruby. I'm going to add a lot more features to it. I'm going to have a lot more stock recommendations in there over time. But I think you're going to find it's getting revamped in a really cool way. It's going to be different than anything else out there. It's going to be more fun. It's going to be more informative, and I think it's going to be an absolute gem of a resource for everyone. So been working on that for some time now, for a couple of weeks, and I got a couple more weeks of work into it. And then I think when we get the right set up in terms of a website, and I want to make it a little more interactive. It's going to be a lot more stuff going on there. A lot of really cool stuff. So thanks for your thumbs up on that. Sergio, do you think the next state that shuts something down send the market tumbling as it did this morning? It's not going to be good. If we see more shutdowns, Sergio, the market is going to react probably tepidly at best, and perhaps see more selling down to a point. It's possible that we trigger some of the retail selling that we've been afraid might happen and push the market down. This is happening at a pretty tough time for the market. And by that, I mean, if things start to close down now, if investors get nervous, if retail stops buying, and they pretty much have settled down for now, they're kind of doing a lot of nothing after having bid the market up for everyone. What's happening is institutional investors haven't followed suit. They're on the sidelines. They've certainly bought in, but they haven't bought in enough. They're waiting, because as we come into earnings season, if retail falters and the market comes down, okay, it's coming down today, that's not enough for anyone to jump back in. It's not a buy the dip point yet. It may be for some people, but what institutions are waiting for to see is the market going to give way? Are retail investors going to start selling? Are they going to turn into panic mode and dump stocks? If they do, then this market can come down quickly, heading right into the end of the quarter, right into the beginning of earnings. That's a terrible setup for the market. And it's the only thing I worry about right now is the confluence of those things happening and institutional investors not coming in and hedge funds and other big traders pushing the market down because there is a lot of profit taking to be had. And then you're going to get to the point where a lot of retail investors are at break even. And then you're going to get to a point very quickly where they have losses. They're going to start dumping. And if they start getting margin calls, this could turn ugly. We're not there. We're not anywhere near there. That is my fear at this juncture coming into the next 2 weeks. This is where that's what I'm worried about. And we're coming to the end of the quarter. So again, it's unfortunate that we're seeing a down day today. Would have been nice if we'd had on the heels of yesterday's closing rally, we'd had some momentum today. That would bode well for the end of the quarter and some window dressing. We may not have that now, so that's something that worries me. So yes, more lockdowns could put more pressure on the market. The reason is really there's just a lot of profits out there, and underlying the profits, there's this vacuum of investors way down here who never bought into the rally, who never trusted the rally, and then the retail investors and the institutions that chased it up are now holding the bag. So there's a big vacuum below there, and it's quite easy for the market to drift lower and reach certain support levels and then hit those, go through those, and tumble. I don't see that happening. I'm just putting it out there as a warning. So keep that in mind. We're going to be looking we're going to be looking at the news to see what happens in terms of shutdowns. And here we are again on a Friday. We're back to, at least today, we're back to selling off on the Friday. The weekend is ahead of us. The market is not closed, so anything can happen. But at this juncture, it would not surprise me if we ended up higher on the day. It would not surprise me if we ended up down 5% on the day. That's exactly where we are. So it's not a comfortable position to be in today. Peter, any website stock analyst's site worth following? TipRanks, Yahoo Finance, Stock Target. DataTrek is one, Peter, that I really like. A lot of really great metrics. Also Zero Hedge. The Zero Hedge has some pretty interesting articles. Sometimes some of them are they're in depth and really well done. They've gotten a little political in some of their stuff for sure, but there are some really good pieces at Zero Hedge. But DataTrek is one of those resources that I use. Really great numbers, lots of great data points on there. And let me just, I'm not sure exactly what, because I have it just on it's always on my go-to. Let me see what the exact website is for you guys. But I've mentioned it before, and I do use it. I read it every day, and there's a lot of good stuff on there. There's a lot of stuff out there. A lot of it I brush off because the analysis isn't, to me, up to par. The analysis here on DataTrek, and the website is DataTrek. Let's see. Just want to give you, because I get it, DataTrek morning briefing. So try DataTrek morning briefing or DataTrek, DATATREK research.com. That's probably your best bet there. These guys are good. Okay. It came out of some great places, including SAC, Steve Cohen's shop. So they got their act together. They know what they're doing, and some neat stuff. So there's a good resource for you. UTG a hold. Ruby is asking. Let's have a quick look at UTG. Reeves Utility. Haven't looked at this one in a while. It's coming down. It's broken through 30 as a little bit of a psychological support there, Ruby. This is, I'm going to have to assume, I'm going to have a quick look at this because the dividend yield 7.2%. You got to love that. PE is, you got to love that. It's like or something like that. It looks 4.370. How can that be? So let's have a quick look at Yahoo Finance and see what payout ratio is. But yeah, that to me looks super. Just because it's coming down to some support doesn't mean it's not a good hold, or doesn't mean it's not time to buy it if it breaks that or add. So we'll take a look. How you guys all doing out there today? Anybody nervous about what they're seeing in the market? Anybody looking at this as a buying opportunity? I'd be more curious about that. Okay, Reeves Utility. Everybody's symbol is UTG, Reeves Utility Income Fund. And we're going to take a quick look at Yahoo Finance and look at the statistics. And then, at least as far as I can see, crazy profit margin. That can't be right. 506% according to Yahoo. Revenue 69 million. And let's see, it's got debt 445 million, 90 good cash flow, operating cash flow. According to Yahoo, payout ratio is 30.47%. Wow. No sizable, no short position to speak of. Wow. I mean, let's just take a look at the profile, because it looks pretty, according to the brief read at Yahoo Finance statistics page, color me impressed. Reeves Utility Income Fund is a closed-ended, balanced mutual fund launched and managed by W.H. Reeves and Company. The fund invests in public equity and fixed income markets of the United States. It seeks to invest in securities of companies operating in the utility sector. The fund primarily invests in dividend-paying stocks and debt instruments of companies. You got to go with it. It seems to be managed pretty well. And if that's the payout ratio at 30, well, less than 31%, then yeah. I like it. Thanks for bringing that up. I'm going to look into that for everybody and keep an eye on that. Thank you for bringing that up. Love it when you guys come up with some cool stuff like that. Thanks. Peter, New York, New Jersey, requires visitors from certain states quarantine 14 days, forecasts of marking downturn if this spreads. Yeah, they have been requiring a 14-day quarantine, and you have CN in there, so I guess that's Canada. But some, I know New Jersey does, New York has, and I came up from Florida, and before they imposed that, and Florida has it too. You're supposed to quarantine in Florida if you go down to Florida from any of these high-risk states. So we're seeing more of that, and that's again being reflected in the market. I think that's what the market is fearing. That's again the headline news. So the more we see of that, yes, the more pressure there will be on the market. Ruby, thanks for money map. You're welcome, Ruby. We've had some good winners there, a couple of ones that didn't pan out, but we certainly had some nice big winners there recently. That Altrex is a home run for sure. Sufi, I have an XLY 129 call, and you guys know that I really I'm not inclined to recommend any specific move for any particular person, because that's not what I do, and I'm not your financial advisor. So when I talk to you, when I address a question about an option, about a company buying it, selling it, or a stop, it's general for everybody. I will never give out specific information to anyone, any recommendation to anyone. I could never do that unless I knew your entire financial situation, could give you advice based on a full picture of your financial condition, what you needed, and all of that. So you know how that works. So just that's a caveat disclaimer. So I'm going to take a look at XLY, and you got the 129 calls, July 129 calls. You've got a little bit of time, but it's dwindling. You're going to have to see a pop on this, I think, next week. For you, you'll have enough time if you get a pop next week. If the market continues down, I would say maybe you're running out of time, and you may not have much of an opportunity. But you got the 129s. This thing's going to have to make a move now, and depending on what you pay it, the chances of it getting to 129 by expiration are dwindling. So I'd say be careful with that. That it just doesn't look like you're going to have enough time, given the market condition and given just looking at XLY, the consumer discretionary chart. It's a little bit of a downturn there, and I don't know that it's got enough juice to make it back up to the 129 level by your expiration. So I'd be a little cautious on that one. Prospects for ZBRA. Well, the thing about options is, when you have a little bit of time left, I mean, less than 30 days to me is a little, then not that 30 days is a lot, but less than 30 days is certainly something you have to be concerned about, because your premium, what you paid for that option, is getting eaten up by time every single day. And if the underlying instrument is going in the wrong direction, in other words, if you own calls and the instrument underlying is going down, you're getting further and further away from your objective, further and further away from the strike price that you're hoping that the option gets to. It may not have to get to that. Sometimes you need a spike. If you bought the options cheap enough, you might get a spike that gets close to it, and that can happen even with a few days left. But it's going to have to be a heck of a spike for you to break even or get out with a profit. But when you're looking at a market that's being weighed down by news that's national, that we know knocked the market down before, and your underlying instrument is trending down with the weight of the market trending down on top of it for the moment, you're getting further away from your objective. It means you have less time for a really big move for you to recover and get back the premium you paid. That's always going to be the case with options. So for everyone out there, be careful when your time is less than 30 days. Be really careful. You're down to 15 plus days. I'm not including the weekends, so calendar days. Be careful. Peter, MGM now requires massive property. That's a good thing. Stock slumps on this news. But I thought, Peter, that they had put that news out there a while ago. I didn't think that was new. I thought that had been in effect for a little while, at least a week or so. I could be wrong. Stock slumps on the news. You probably know better than I. Casino is not a good short-term bet. Las Vegas and Wynn do. No, not a good long-term bet or short-term bet. Well, maybe if you're playing from the downside, you want to day trade some of these companies. We talked about this, and we will talk about this: the airlines, the hotels, cruise lines, the gaming stocks. They're good. They're good short-term trades. You can swing trade these. You can make a lot of money if you're an agile trader, but you have to look at them as trade and try and take your profit. So if you play them from the short side, you buy some puts and they go down, take your profits. You play them from the long side, you get a 5, 15, 20% pop in 2-3 days. Goodness gracious, take your profit. Unless we start to see that we're really out of the woods, then if you get a nice profit, maybe let it ride a little bit. Maybe it's like it could turn into investment, because MGM could go back up to 30, could go back up to 35, but it's going to take a good long while. I don't think you see that happening anytime soon. Same thing with the other gaming stocks, same thing with the airlines, same thing with the cruise lines. Those are good trading stocks right now, for sure. Ruby, no buying yet. No buying yet, Ruby. I don't think it's just, we're not there. Rafit, hi Shah, do you think this sell-off is predicting possibly poor second quarter results? No, I don't think this sell-off has to do with second quarter results in isolation. We know, the assumption is that we know that second quarter earnings are going to be bad. we know that the market's already discounted that. How bad they are remains to be seen. The thing is, if they are better than expected, and they've already been knocked down precipitously, if they're better than expected, and we get some positives in there, unexpected positives, and we start to get some forward guidance, kind of a stretch to expect that, but it's possible, because some companies that have the ability to provide forward guidance because things are better than expected have maybe already started to see some turns. That would bode very well for the market, because again, here we are, we're on the other side of it, and people are starting to see we are on the other side. So earnings season is going to be a big deal. This is not about earnings sell-off and the market's getting hit further and harder as we talk here. So I don't know if there's any additional news coming, but this is that midday kind of sell-off, and we'll see how it lasts. But really, this is about the spikes, it's about the virus spikes, and yesterday's news that regulators were looking at, were telling the banks no more buybacks and no dividend increases till at least September. That's the news that really moved the market, okay? Because that says, does the Federal Reserve, do regulators know something we don't about the banks? That's always a reason for the market to worry. That's where this really sells. The news sounds like, it's about the spike. And yes, it is. That is the headline news, and that's certainly impacting the market. But underlying investors are really more apprehensive about regulators coming out and telling the banks, not so fast on your buybacks or your dividend increases. Pablo, hi, Shah. What do you think of, okay, you got ACCO. ACCO, ACCO Brands. I gotta say, the stock looks pretty good. It's had a nice move up. It's holding up. Nice dividend yield. PE it's darn right cheap at 5.4. So let's just take a look at Yahoo, because it almost looks too good to be true. We'll just take a quick look at the metrics. And again, I'll say this for everyone, and it's something you might want to consider doing, is when I go to look at the metrics, I'm looking at Yahoo Finance, and I'm going to the statistics page. And if you follow along, it's something that you can get used to doing very quickly, very easily. Just a snapshot. You want to have a quick snapshot before you start digging into, really, do you want to take a deep dive into a company's stock and to see whether you want to buy the stock or short it. I start here. It's just a quick snapshot. It tells me what I need to know. So right off the top, I like the profit margins here. Revenue is just shy of $2 billion. It's got $93 million in cash. It's got $1 billion in debt, but looks like it's got really good operating cash flow and levered free cash flow, so enough money to pay the debt. The payout ratio, according to Yahoo, is 21. I sometimes double check this, but I'm eyeballing it right now. Payout ratio at 21.74%. Shares outstanding. I want to take a look at the shares outstanding, and I do a quick calculation on the shares outstanding times the dividend to see if it makes sense, if it's right. So shares outstanding, we'll call 95 million. And dividend rate is 26 cents. Net income available to common is 115 million. So they got plenty of coverage. So yeah, I do a quick calculation in my head like that. That's close enough. I like it. It looks pretty solid to me. Yeah, I mean, the stock was going along nicely, a little sideways prior to the COVID, but was trying to bounce back and is still trying to bounce back. In fact, we're going to take a look at this graphic because it's a nice stock to look at. So thanks for bringing this up, Pablo. So we'll look at that real quick. We're going to do a couple more, and then we're going to go to the graphs, and we'll take a look at a bunch of stuff. And the other one was BPFH. Again, everybody, I want to thank you for your questions and for bringing up some of these stocks, because we all benefit by some of these picks that you guys are looking at. Some of them are terrific. Some of them we also benefit by because maybe we take a hard look at them and they're not good, and maybe there's an opportunity to short them or buy puts. So always great to have those questions, and it's fun to look at them. So this is Boston Private Financial Holdings. I don't know anything about the company. 7.67 yield. So that looks good. Stock hasn't really done much. It's gone pretty much sideways and in a very volatile fashion. So let's take a look at that one. I'll have a quick look at that for everybody at Yahoo. So this is BPFH, and it's Boston Private Financial. So I don't know what it does. It's got, real quick, it's got a dividend yield of 7.67%, PE ratio 8.55. So obviously, on the surface, looks really interesting. BPFH. A quick dive in, again, just heading right over to Yahoo statistics page. Eyeball this thing real fast. And profit margin 19.8%, very interesting. Revenue 300 million, so doesn't produce a lot. Net income $61 million. Debt a little high at 996 million. It's got some cash on the books, 155. I don't, sometimes in a situation like we're in now, cash can evaporate very quickly depending on what the company does. And so you got near $1 billion in debt. That's a bit worrisome. And quarterly earnings growth is negative, substantially so. So the payout ratio is 65%. We've got 81 million shares times 48 cents. So $50 million, less than that cost. So I'm just rounding stuff up. I like to put lots of cushion in there. And net income available to common is 61. It's pretty tight. This one's tight. It's not 65%. It's higher than 65% ratio here. So this one's a little tight. The stock looks pretty decent, Pablo. If it stays above 6, it's low today, 618. It's got support at 6, not tremendous support. It's got some support at 6. If you like it long term, then you're okay. But it's just a little shaky down here with that dividend starting to cost them, and that debt load is starting to weigh a little bit. All right, a couple quick ones before we head over to the charts. You're welcome, Sufi. My pleasure. Peter, do you use MACD for buy-sell points? Doing research, found this. Do I? I look at it. I don't use it. It's not. I use it among other metrics, but it's not a go-to for me. I find it. I find there's too much lag in it. It doesn't do it for me. If I can take the lag out of it, and I have a system that does take lag out of it, it's better, but it's not on its own a be-all end-all for me. It's just not. But yeah, it's, again, put it in your arsenal, something to look at because other people look at it. TTD, Dick is asking about. What to do with TTD? Trade Desk Inc. It's had a heck of a run, Dick. Hopefully you own it a lot lower. Absolutely fabulous run. This is one of those stay-at-home stocks. This is one of those companies that everyone's plowed into. And you're down a little bit today, down 1.15%. It's lofty. My suggestion is, if you don't like the market, and certainly it's looking a little shaky today, it hasn't broken down, take your profit. You can always get back in lower. And if it goes higher, you can get back in higher. Again, I say that with the caveat that I don't know what anybody's tax consequences are, but I just know that I don't mind paying taxes on a profit. It's just what we have to do. So I just hate giving up a profit. I'd rather pay taxes on a profit than not have a profit. So if you had a nice ride with that, and hopefully you bought it a lot lower, I would not want to give up much here. And we're at a point where the market might bring it down, but then again, it's also one of those stocks that the market brought up. If we get more lockdowns, if we get the prospect of more lockdowns, that's why the stock went up in the first place. Stay at home. It's part of the whole work from home and it's certainly. So I don't know that it's going to. I don't think it's going to collapse, but for me, there's no harm ever in taking a profit. And if you're nervous about the market, I don't care what companies look like, why or how they've performed. If the weight of the market is such that it's going to bear down, all stocks are going to get hit. There are going to be very few that escape a real nasty sell down. We're certainly not there yet, but that's the only thing probably for me that I'd be concerned about with TTD. If we get a nasty sell down, I'd certainly want to take my profits before that happens. That means me, so I don't mind exiting early. I don't mind bringing a register. Hey, it's Friday. Bring the register, go out and find something to do. Okay, last before I go to some charts, Peter's asking about good old Alibaba, one of the few Chinese stocks that I love. Yeah, it's down. It's not that down. It's not down that much, Peter. I wouldn't be worried about it. Again, look at this. Look what the stock was doing prior to the COVID. It sold down on the COVID, and even then, it didn't go down and make new lows, 52-week lows. So it's held up beautifully, and then it really bounced back up, and looks like it might have made a new high. If it didn't make a new high, which looks like it did, at least it reached its old high. That's stellar, absolutely stellar. I wouldn't be worried about it. Yes, it looks like an ugly little fall, but if you're panicking and you're like, okay, I want to take my profit, never a bad idea. I would probably look at 210 and say, if it gets to 210, I don't like the market and I don't like what's going on in China. If I think the Chinese market is going down, then I might say I'll take my profits. That's probably my level. 210 is like, okay, I'm going to bail out for now. But otherwise, if it drops precipitously, get back in. All right, let's go take a look at some stuff graphically real quick. I want to take a look at the majors, the indices, and I want to take a look at a couple of stocks and some of the ones that you guys had asked about. So first up here, I have up the Dow Jones Industrial Average. I want to go through the major benchmarks with you guys. I haven't touched anything. This was here from the other day. I just extended. I had a little bit of a line here. It came to here. I just extended it right before I got on the call with you all, and just to show you where we are here. So we've obviously broken this uptrending channel. This is this really nice uptrending channel that we made, and we're still above the 50-day, but we're now below the 200-day. So we're sort of in a no man's land right here. Okay, so we're out of the uptrending channel, which is not a good thing, but it's not a bad thing, because we got some decent support right in here, and if we come down here, which is we're looking around 24,896. So we got a ways to go before we have any worries really about getting down there. I mean, it doesn't mean we can't get down there in a heartbeat. We can, but we're not there. And let's see, the lows of the days above 25,000. The lows so far of the day in the Dow, 25,054. So we haven't broken through 25,000, and getting down to where I see some support, psychological support at least, and certainly some technical support. We're talking about 24,896. So we're okay there. Now, what we can do, and what we all hope, if you're long at least, is that we move along here, we consolidate along here, and the market strengthens back up. We break down here below the 50, and we're probably not going to do that today. Let's hope we don't, because that would be a really ugly close. If we plow through the 50-day, that means the market's going to be off more than 5% today, and that really doesn't bode well. So right now, we're not there. I'm not overly concerned. I would like to see us stay along here and consolidate, and that's the optimist in me. Okay, let's take a look at the S&P, which is not going to be much different. in terms of um, general look and feel of the index, and where its support and resistance is, and what we're looking like in terms of outside of the channel. And there we go. So I simply can extend this channel line here, and and again, we've broken through it. Here we're still above the 200-day here, which is good, which is very good. And we're well above the 50. We're below the 20-day right here, but so far so good here. So let's just extend this channel, and just to give you an idea of where we're at right now and how we've broken through it. So here's that extension of that lower channel marker here. And again, pretty nice, very nice uptrending channel. And we're now outside of it. Is that death? No, it's just, not great. So we'll just hang with it for now and see what kind of support we get. We don't have as clear support here. I would say here we have our support is a little bit lower and a little more outside, which comes right down to the 50-day, which doesn't surprise me. So a real quick look here at where support looks to be here. I think we could probably make a case that support is really right around the 200, just perhaps a shade below the 50-day. So we got a ways to go before we're in any kind of trouble here. We're above the 200. If we close today above the 200, that's going to be optimistic for investors who are looking at the 200-day. Nobody likes to see stocks break through the 200-day moving average. Certainly not technical technicians who are watching the market through the prism of support, resistance, and technicals. Let's have a look at the NASDAQ. Now, the NASDAQ composite, we know, has been the leadership index all the way up. We know it's outside, but it doesn't look that bad. We're down just a shade under 2%, maybe just a little over it now, because this is bar chart has got a 15-minute delay. So we're a little bit below that, but again, we're well above here. We got a lot of room to move here. We got some support way down here, but then that's considerably lower. That's a lot lower than we are. That's 9,400 and change. We're at 98.25 right now, and so we're nicely up here. We're above the 20. We close above the 20 today. If we manage to rally on the NASDAQ, then that's a positive sign that the big mega cap tech stocks have held up today. So this is one of the reasons I'm not overly concerned at this juncture about what we're seeing today sell-off wise. Again, I don't mean to be flip-flopping on you, but obviously that can change. And we could certainly see a hard sell-off into the close. It's one of those days where investors might just say, "I got enough on the table. I'm going to take it off because I don't know what the weekend's going to hold. Maybe more stuff will get locked down. Maybe we'll come back in on Monday and we'll find out that a couple of states have shut down, and then they'll be too late to sell because the market will gap down." So we certainly could see that going into the close day. Would not surprise me coming into the end of the quarter, and retail possibly looking to take profits and or cut any losses they may start to dig into. So have a real quick look. All right, let's just go into some of the stocks. BRG. So I want to talk about REITs and dividend-paying stocks. A lot of great dividend-paying stocks out there. It's a question of payout ratio, coverage ratio, and a couple other ratios we're going to talk more about next week. And guys, take a look at my Total Wealth article that's coming out today, this afternoon. I start the conversation in there about dividend paying stocks and the kind of ratios that we should be looking at if we're going to be buying dividend yielding stocks. And I am very big on them. I think we're going to see a lot more companies paying dividends starting probably towards the end of this year, certainly next year. And we're going to see a lot more companies raise their dividends. Why? Because we're going to see a lot fewer companies doing buybacks. And there are going to be some reasons for that. And they're political and they're regulatory, and they're coming. No one's talking about them, but I'm letting you know. So I'm starting the hunt for good dividend yielding stocks, and I want everyone to understand what it is you need to look for. So REITs have to pay out 90% of their net income, and that allows them their structure tax wise. So heck of a run here, coming back down. And again, if you really like, this is particular to the REIT and what they do, what area they're in. And this is Blue Rock Residential growth. So it was going along quite well, thank you. And then all of a sudden it gets hard hit by the COVID. The yield now at $7.41 is 8.77%. Now we're going to have a quick look at BRG in good old Yahoo. I just want to get a quick shot at their revenue coverage and et cetera, et cetera. So yeah, nice profit margins on Blue Rock. We've got revenues are reasonable, 224 million. Earnings look really good in terms of growth. Cash got 19 million. It's got a big debt load, 1.52 billion. I do not like the operating cash flow, leverage free cash flow at less than 75 million, and levered is closer to 52 million. That's a little weak relative to the total debt of 1.52 billion. Net available to common is negative. Okay, so what's the payout ratio? Guess what? It's more than 100%. In other words, they're paying out everything that they have, the net interest available to common, which is negative. So they don't have enough money to pay the dividend right there. So how are they paying the dividend? They're borrowing. That's the only way they can pay the dividend. How sustainable is that? It's not. Okay, so be very careful on this one. That's why I look at the REITs. That's why I look at all the dividend paying companies right now. What is the likelihood of them cutting that dividend? And in terms of this kind of company, but it's give you the heads up for everyone else. It's a real estate investment trust that focuses on developing and acquiring a diversified portfolio of institutional quality, high amenitized, live, work, play apartment communities in demographically attractive knowledge economy growth markets to appeal to the renter by choice. Okay, that's real fancy. But don't forget, there's abatements going on. People aren't paying their rent. People aren't paying their mortgages. These people aren't getting the cash flow that they need if that's what's happening to them. They're going to have to borrow. So how are they going to pay their dividend? Be very careful on this one. Okay, IRT was another one. But yeah, when you're looking for dividends, when you're looking for payouts, you really, the first and foremost, it's not about how big it is. It's about the quality. It's about the quality of the dividend, the quality of earnings, and the sustainability of those earnings and net to pay that dividend. That's what matters. That's the only thing that matters when you're looking at income yielding stuff. Dividends are, I think, going to be a larger part of what people are going to be looking for going forward, starting in 2021, if not sooner. IRT. Okay, IRT, I was looking at the stock here, and it's the Independence Realty Trust. Again, just real quick on the dividends and the PE, just so you know, because this is the superficial stuff you look at, and sometimes you get mesmerized by, oh, wow, $11, and it's got a yield of 4.34%, and oh, PE is reasonable at about 23 23.36. It's like, oh, okay, not bad. So the stock looks pretty good graphically. Still in an uptrend down there. I mean, don't sneeze at that. I mean, that's a good thing. So we've got this nice uptrend still intact here. We got very nice uptrending channel. I could very quickly draw the top channel line. And so we've got a pretty nice move off the bottom here, and a reasonable dividend. So the question here is on IRT, how good does the dividend look? Real quick, the revenue is $205 million. Its debt is just a shade over $1 billion. The payout ratio is 151%. Okay, I don't have to do any math. I don't have to look at the shares outstanding and multiply that by the forward rate. It just real quick. It's just I can do that, and I know roughly it comes to probably more than around $50 million. We'll call it. I always round up. And what's the net interest available to common? 42 million. So it's the dividend. The dividend is probably pretty close to what the net income is. So they're paying that out. They got a big debt. And they still have to service that debt. And what if they're again, if they're going to have to cut that dividend? Then do you really want to hold that? I don't know. So we'll have one quick last look at the profile of this one and see what Independence Realty, what's their preferred game. It's a REIT that owns and operates multifamily apartment properties across non-getaway U.S. markets, including Atlanta, Louisville, Memphis, and Raleigh. IRT's investment strategy is focused on gaining scale with key amenity-rich submarkets that offer good school districts, high quality. Now, sounds pretty reasonable, but with the dividend, you got to be careful. But right now, the stock, just based on how it's trading, I would say hang in there, because unless it breaks down, other investors are supporting this stock, and so hang in there. I just be concerned when I look at the payout ratio, when I look at the perhaps if their revenues start to slide. Again, you don't want to see them borrow to pay that dividend. And these companies, the REITs, will borrow to do that because it's a matter of time for them. Can they outrace the clock? But this one looks better than BRG. Okay, go to Frank. Asked about a couple. ESPO. VanEck Vectors Video Gaming and Esports ETF. That's a pretty cool ETF. Wow, rocket. So again, not surprising, right, Frank? You know why you bought it, and hopefully you bought it down here somewhere. Stock really had a night, was moving up nicely. The ETF was moving up nicely. We know the COVID, what was going to happen. And all of a sudden, investors say, well, wait a second. If people are going to be at home more often, they're going to be doing more video gaming and esports, and makes perfect sense. Me, on this one, I'm just going to watch my profit and be happy that I have had a tremendous run in it. And I'm going to be worried about, like, do I want to give that up? You can always get back in if it goes lower. Right now, you don't have to. I wouldn't rush out of it right now, because if we're going into more lockdowns, these are the stocks that people are buying for that reason. So I wouldn't rush to exit. Maybe consider taking some profits if you're nervous, or you can always buy some puts on it. If they're not too expensive, and they're probably reasonable. So that's another way to hedge yourself on this. But this is the kind of company that right now, it's obviously it's not getting hit hard today, because again, it's one of those stay-at-home stocks that works with the lockdown. So it's a great pick. It's a good. Thanks for bringing it up, because everyone else will want to take a look at this too. It's a little late to get in. I worry about the lockdown ending. I worry about other side of the virus. I worry about treatment, vaccine, and what is going to happen to a stock or an ETF like this. That's when I think to tell you guys, take your profits. Don't be greedy, because right now we're going back into some kinds of shutdown, some kind of lockdown, some kind of stuff. We'll get past it eventually, however long it's going to take. We'll get past that, and a stock like this, an ETF like this, is going to see some pretty quick profit taking. So be careful on that. But right now, you're in a great position, and congratulations on a great pick. CGNX, also from Frank. This one I don't know. It's had a heck of a run. Stock looks pretty good right now, Frank. This is you come out a little bit side of this. You had a nice run up here for sure. Stock was going up nicely. Um, was it had gotten above its 200-day, got above its 50, was moving on quite nicely. Gets hit by the COVID, and not unexpected. Now, how does it react? Still above its 200, still above its 50, still above its 20. What's not to like? So you're down a little bit today. This stock looks pretty good graphically, and I wouldn't worry about it yeah, unless maybe it has the audacity to come down here. Then I'd start to think, why is it weakening? But right now, it's certainly going in the right direction. So I say keep a good tight eye on it and enjoy the ride. VTG, we had a question about. Vistagen Therapeutics. Okay, VTGN. Again, these inexpensive stocks here are rocket riders for folks. It just, expectation is, percentage wise, you can make huge gains. This one doesn't seem to be doing much of anything. In fact, I just don't like the action overall. It's a lot of volatility here. And obviously you have this huge gap down here. What do we say about gaps? They tend to get filled. How about that? Fill the gap. Okay. So again, on and on. Sometimes I'm going to sound like a broken record, but with good reason. Ugly, ugly, ugly gap. But sure enough, as ugly as that was, here we go. Does that mean that the stock is now out of danger or that's now on its way back up? It doesn't mean anything. It just means a lot of speculation. I don't like this action. This one would make me nervous. This is to me, a speculative stock. So I would play it that way. Just want to take a look at Inovio, see how it's doing. Again, one of the coronavirus crisis winners, and that's a heck of a move. It's like that. That says, hey, this company is gonna be one of the winners in the treatment or vaccine game, and good luck to all of us. Well, let's hope it is. If it isn't, that stock is coming right back down. So if you guys own this, I would certainly be inclined to protect what profits I have. So just want to bring that up. So I think that's about it. Did I cover everybody? I think I did. And then I'm going to go hit a couple of questions. Pablo, I think I don't even remember if we covered these or not, but so far so good on this. And I think you had BPFH, which we looked at again. So far so good. I think we've covered them all, everybody. So yeah. Let's go to some questions and we'll wrap it up. And as we speak here, we're looking at the Dow down 2.26%, S&P 1.86, NASDAQ 1.79. So come back a little bit on the NASDAQ and a little bit on the Dow. Excuse me, on the S&P. The Dow is not looking so great, but we're far from over. Day is far from over. So I'm going to hit a couple of questions and bid my bon weekend to you all. If you guys have any questions, let's have a quick look. I think I got you guys. I believe, I hope I have most of your questions. I'm going to come back and double check. Peter's asking about MPLX LP owns and operates midstream energy infrastructure and logistics assets primarily in the U.S. I'm a little cautious on that one, Peter. Again, energy is all over the place. A lot of these companies are super leveraged, and the limited partnerships are especially leveraged. It's just the nature of the game for some of those. So I just be careful on that. Having a quick look at the statistics right now. You got negative profit margin. You've got good revenue so far, but you've got net income available to come in. It's just so underwater. It's ridiculous. It's negative 2.33 billion. Total debt, 21 billion. It's only got 57 million in cash. Yes, its operating cash flow looks really good at $4+ billion, but that can dry up and probably is drying up fairly quickly. So I'd be very apprehensive about this. 390 shares outstanding, over a billion. Okay, dividend. Forward dividend rate 2.75. So that's 2.7. Let's call it $2.75 billion in dividend payments, and they're losing money. Where's that money going to come from? Okay, net income. Their net income available to come is negative 2.33 billion. Okay, they're going to have to come up with billions to pay the dividend holders. I would be very, very apprehensive about this one, to say the least. Couple real quick ones. Martin is asking about, well, let me get back to Rafit. Oh, got a bunch of questions, you guys. I'm trying to hit them real fast in order. Sufi, good hedge for Zwillow and Lennar housing stocks. I don't know about a hedge right now. The options are probably going to be pretty expensive today. Lennar is down a little bit. You might want to look, if you want to hedge Lennar, and look for the options. The stock has held up pretty well. It's really right now pretty much close to some support, and let's see if it can hold support here. It looks like probably, I would say, about 57.50. It's got some support below that. Maybe you want to think about taking some profits if you have them. Otherwise, if you were looking for a hedge, maybe pick up some puts on that, a little protection there. And have a quick look at some of the other ones for you guys. Okay, let's go to, you're welcome, Julian. BCLI. Sorry, my other computer's acting funny. Oh, wow, what a rocket ride. Up 11%, Brainstorm Cell Therapeutics. Gosh, Rafid, what a nice rocket ride. I hope you own it. What do I think of it? I think you've done very well if you own it, and congratulations. I'd be nervous about it. It's really come out of nowhere, and it's gotten a lot of interest lately. So I'd just be cautious about giving up my profits if you're sitting on some really nice profits, and hopefully you are. It's just a moonshot and up 11% today. So obviously they're doing something right. Without getting into it, I would just say, great stock. Don't give up too much of your profit in there. It's come up really quickly. So unless they have a home run or a grand slam in their back pocket, and that stock is going to see some profit taking at some point. LYB, Martin is asking about. Okay, Martin, let's take a look at LYB. I like the company. I've liked them for a long time. Lindell Basel Industries stock has done very well. It's coming down. I think you're going to see some support at 60. It's low today, 61.94. Below 60, it could get down to 50 in a hurry. But I hope if you own it, I hope it stays up above 60. It's got some support at 60. Should be reasonable. If the market holds up, the stock should hold up too. Below that, it's a bit of a vacuum below that, and I could see the stock stumbling to 50 fairly quickly. Where there's got some additional support there. I just be a little apprehensive about that. It's got a great dividend yield. I don't know what the payout ratio is. Have a real quick look at the payout ratio for you. Again, everybody, when you're looking at these beautiful dividends, make sure they're sustainable. And that's a function of dividend payout ratio and a bunch of other stuff. So read my total wealth piece today and take a look at some of those easy ratios to calculate. And you just want to keep them in your back pocket because you're starting to invest in dividend companies, and we're going to be doing a lot of that a lot sooner than people realize, because for good reason. You want to have a good fundamental understanding of what's important in measuring dividends. Profit margin here, 8%, nice. Net income available to common, 2.72 bill, so really good there. Debt, 15 billion. They've been carrying a lot of debt for a long time. They've got the cash flow, operating cash flow to cover it. Payout ratio is 53.6%, so looks pretty good. 333 million shares outstanding. Was 1.2 billion. Yeah, that works. I would stay with it. And if it's a long-term hold, I wouldn't worry about it. I like it. Again, I think it's a good company. Dick's asking about NVIDIA. So a quick look at NVIDIA. This is always a time when we see the market falter, where everybody gets a little bit nervous, and rightfully so, about hopefully whether or not you should be taking profits as opposed to losses. But judging by some of the stocks you are all pointing out to me, hopefully you guys are smart enough and you've made tremendous profits because you've picked some really great stocks. NVIDIA, another great company, another great stock. Nothing to worry about, in my opinion. You got a nice profit in. Hopefully, you don't want to let that slip. If the market's going to falter or go sideways here, there could be some profit taking in a lot of these stocks that run up. For no other reason than this money to be had. Take it off the table. Other investors are going to take the money off the table because nobody knows what's going to happen. The thing that's ahead of us, we know what's in front of us, which is the virus. The thing ahead of that is earnings. We know that's right around the corner. The thing ahead of that, and it's probably the biggest question mark, is the election. All right. So there's a lot to be worried about. There's a lot of stuff that can upset the market. So again, you got profits and stuff, folks. Don't be afraid to take it. I don't care. You shouldn't care if you take a fat profit in something and it goes higher. Who cares? It might come down later. It might continue to go higher. So what? So you missed some money. If you made money, don't cry about it. Julian, you're welcome. Software stocks to look at. I will work on that. Sebastian, what's your opinion on Baidu? I like Baidu. Stock has been pretty volatile, but it's in the right place right now. If you own it, it's making a good move up. It doesn't mean that it can't drift back down. It's got a little bit of a gap to fill down there, but so it could break 120. The low today is 121. Baidu, it wouldn't surprise me if the market got hung out to dry. Baidu gets down to 110. If it gets down to 110, it could get to 100. So this is one where I would probably look to certainly figure out where I want to take my profits, and maybe be quick about it, because Baidu has had a nice run, but just the break higher, I'm a little worried that investors might want to take some profits. So I give that a consideration. But still, the stocks had a nice run. It's that little gap that worries me. Um, and the trading's been a little sloppy, but it's been so far so good. It's in a nice uptrend, so you're fine. Again, if it's a long-term hold, then stay with it. Me, I'm looking to take profits on some of these high flyers. Baidu hasn't made new highs, so it's one of those ones that still has potential to go higher. But at some point, again, if I think the market is getting weighty, I'm going to probably take a lot of profits. And certainly you've had some profits in Baidu if you bought it lower. Jay, love your service. Seeing 5,000 January 21, 30, 37.5 call spreads being bought today on WFC. Is it a hedge for shorting? No. I don't know that it's a hedge for shorting. It could be, but if you're going to hedge on the short side, you're probably not going to buy a call spread. Is upside play. Again, Wells Fargo is you gotta. I'm not saying I know. I'm just saying I try and, as an analyst, look at everything I can look at, and that includes coming to some conclusion. It's not just reading the numbers and letting them tell you what they tell you, because sometimes they don't tell you enough. You still have to come to a conclusion, and that requires, like, okay, what could that mean? How do I decipher that? How do I put those pieces together? What could happen? And you sometimes have to add your own interpretation, your own logic, and experience. And in my case, it's a combination of those things. And I also look at Wells Fargo as it's a high yielding bank, a too big to fail bank. And we have the playbook. We know that these too big to fail banks don't fail. We know that their equity gets hit. We know that every time that gets hit, the harder it gets hit, the better a buy they become, because they're not going out of business, period. So do I like it down here? I love it down here. Okay. Can it go lower? Yes. Would I buy more lower? Yes. Why? Because it's a long-term hold. And the dividend at 7.99% is just too good to give up. And yes, it could get cut. I don't think it'll get cut. I can't imagine, if I'm management there, if I'm the CEO, CFO, there's no way I'm going to cut that dividend as long as we can support that dividend. I'll only cut it if I'm CEO if coming into the quarter, we have our revenue gets sliced by 20-25%. Then I'm going to have to think about it. If we see a revenue fall off of 5-10%, and we still have good coverage ratio on that dividend, there's no way I'm cutting that dividend, because we're looking now at the backside of COVID. We're looking at the backside in a couple of months of the recession. We're looking at things getting back to wherever they can get back to, however soon they can get back to. But at least we're not going into the pit. We're going to be closer to coming out of it. So yeah, I like WFC, and I think the call spread makes sense. So that's a nice spread. At 5,000 contracts it's a nice round number. I like that. I wonder who did that. Okay. Jesus, what's your opinion for next week's markets? Well, not to sound flip, but I have to say it's going to be probably volatile. I don't know what the direction is. Right now, the inclination is you want to lean towards oil. It's kind of ugly selling into Friday, but we know that's not unexpected. It's not panic selling. Okay, again, we could end up down 5%. We could end up flat on the day. So I just think that we're now at a point where there's a lot of questioning about, well, what's next? And that's what makes nervous investors. What's not knowing. All right. Indecision, not knowing, that's when investors tend to sell. That's not usually a time of conviction where investors come in and buy and bid up the market. So we're at that place. We're at an interregnum right here, right now, where we could go sideways, we could go down, we could trend back up a little bit. I don't know that we're going to trend back up just yet. I think when we get into earnings season, if the earnings are better than expected, then yes, we get back to heading higher. In the meantime, we're just in a bit of a danger zone. So my expectation for next week is probably volatility. My bet would be on volatility. Hey, everybody. Hope you all have a great weekend. Thanks for sticking with me for so long. Kept you a lot longer than I normally do, and that's long enough. So thank you all very much. Be safe out there. Cheers. Enjoy the weekend wherever you are, and hopefully you're not locked down somewhere. Cheers.